In this video, I want to elaborate a couple of things from designation memo, and that relates to the effectiveness test and financial statements impact. For the effectiveness test, you can dedicate special kind of effectiveness test for separate set of your derivative instruments used as a hedging contracts. That means that in designation memo, you're describing the risk, you are describing the contract that helps you to hedge that particular risk, and also you tell what methods will be used for the effectiveness testing. I propose to use simple method for simple cases, because it's already a little bit complicated. I mean, the exercise itself to implement hedge accounting into the practice. So let's use the simplest available way for effectiveness testing. And if it's forward contract to hedge operating expenses, for example, or specific outflow, it's black and white situation. You have your exposure almost certain. You prove the probability that transaction will happen, and you buy specific forward contract to protect yourself from the change of exchange rates. US GAAP allows you to use critical terms match method for effectiveness test, and that's really simple and really helpful. There are a couple of conditions that you have to meet to use that method, and these are literally, let me state them. The hedging instrument is for the patches of the same currency. Check mark, obvious. The fair value of hedging instrument at inception is 0. This is normally the case for forward contracts. Third one, the change in expected cash flows on forecasted transaction is based on the forward exchange rate. That's basically what you're doing. You are hedging your forward rate risk. So you're fixing your forward rate. Check mark. And the last one, the group of forecasted transactions being hedged are expected to occur within the same fiscal month as the maturity date of hedging instrument. That also should be true for you, because you are buying your hedge contract for the specific period of time that will happen in the future. For example, you are hedging your first quarter of the next year, or most likely you will hedge every single month separately. And the standard allows you the window within 1 month, so transaction happens during 1 month, your OPEX happens during 1 month, and your value date on your contract is somewhere within these months. Beginning, middle month, end of the month. It doesn't matter from the accounting perspective. So, and by stating that critical terms match between your exposure and your derivative instruments, you are not doing anything else for effectiveness test. Think about it. So you're only proving that all critical terms are matched perfectly, meaning that, for example, this 1 million euro of exposure, and you're buying forward contract for 1 million euro. Currency, same. Timing, same. It will happen in 1 year. You are buying forward with value date in 1 year. So spot rate in the future, called forward rate here, will change somehow, and it will give fluctuation to your financial statements on your exposure, and it also will give fluctuation with the difference, with the opposite sign on your hedging contract, and you will have net effect of 0 in your financial statements. That is the purpose of hedging, to have predictability, to have that effect of 0. So I vote you will use these critical terms much, otherwise you will have to hedge, you will have to use regression analysis. That's also kind of not very difficult, but why do you need to overcomplicate things that are already not that simple in substance? Okay, next one, subsequent effectiveness testing, prospective and retrospective. Again, US GAAP allows you to continue to use critical terms much, so please use it. Please create that table that shows your contract, value date, trade date, and then these 4 criteria for the critical terms match. And proof that all critical terms continue to match and you don't do anything else in addition. Period. Okay, you also should read what you will do if critical terms are not longer match. You should write what alternative method for effectiveness test you will use. It's either regression analysis or dollar offset test. Let's bring it up in later sessions. For this one, I just argue you to try to use critical terms match, especially if it's really the case that all the terms are matched perfectly. Because in that case, if you will use regression analysis, it will show the same result. The deviation will be, the coefficient of R will almost equal to 1. That means like almost perfect correlation. And that's obvious. You know exactly your exposure. You're buying the contract exactly to cover your exposure. It should be perfect. Why should you do additional work? Preparing regression analysis, pulling data from different sources, if you can state even at the beginning that it will be perfect. And US GAAP allows you to do so. So please do it. Write it into your designation memo. Write the backup test. If your critical terms match checklist will no longer show yes for every item, you will use alternative. But otherwise, just go simple, use critical terms match, and do not overcomplicate things. Concentrate on strategy, not on the accounting details. If it's not necessary, don't overcomplicate it. Okay, that was it for designation memos. Try to keep it as short as possible, as simple as possible, but at the same time as complete as possible, to have your checklist in place, to go through all the items before you actually do the transaction, just to double check yourself. Not for someone else, not for auditors, just to double check if you're doing everything in accordance with your list. That's why try to make that list user-friendly, for you to understand it, for you to follow it. You should kind of liked at least, it should help you. It shouldn't be overwhelming. Yeah, see you soon. Bye.